welcome everyone, and thank you so much for joining us. We'll begin our presentation. Just to let you know, our presentation will be recorded today. My name is Bianca Carroll. I'm a financial advisor here at Smart Business Solutions, and joining me today we have our lovely expert Shannon Smith, who is a financial advisor, mortgage broker and accountant. So today's presentation is designed to provide an overview of using superannuation to invest in property, which is a strategy that's gaining significant interest. Just to let you know that this presentation will run for about an hour's time. We will have time at the end of this presentation for questions. Also that this presentation is being recorded, as I mentioned just before, and it can be emailed to you if you have registered for this webinar. This presentation will also be available on our YouTube channel and published on our website. So just to cover the fine print, this presentation today will cover general advice only. Does not take into account your personal situation. We can, of course, assist you with that if you'd like to contact us for personal advice. The information today will be based on current superannuation and tax laws and rulings at this time, and they are, of course, subject to change. And to go over today's session, what we'll cover, the key considerations when using an SMSF to invest in property, which will include an overview of property investment, why people are turning to property within superannuation, structuring options, how to structure your SMSF for property investment, SMSF borrowing, so understanding the limited recourse borrowing arrangements. Eligible property types, so what types of property can you actually invest in within your SMSF? Related party rules, so how to navigate those transactions with related parties, and also tailored approaches, so why SMSF property isn't a one-size-fits-all strategy. So I would now like to hand over to Shannon, who will walk us through the structuring, lending, and everything you need to know when it comes to property within SMSF.
Great. Thank you, Bianca. So this is my absolute favorite topic. I could talk all afternoon about this, but I will try and restrain myself from doing that. But I'm really passionate about SMSFs and property. I love property anyway. Being able to do it in an SMSF is such a fantastic opportunity for so many people. So looking at SMSF property investment, now we talked about last week, is an SMSF right for you? So if you're at that stage, listen to last week's webinar. Today is all about property and what we see are some of these benefits from the property side of things. So SMSF investment in real property has really gained a lot of traction over the last 20 years. And part of that is because we never used to have lending capability in an SMSF many years ago. As soon as that started, that gave you the ability to actually borrow and buy a property in your SMSF. It's interesting that 86% of SMSFs, and this is from ATO statistics. Now, some of the ATO statistics are actually, usually they're about 2 years old. The main reason for that is they're all waiting for you to do your tax return so that they can get that data. But 86% of SMSFs reporting an LRBA. So I'll talk more about what that acronym means, but basically we're talking about a borrowing. They actually had one property in there. And as you can see, the light blue is actually the residential, the non-residential commercial property, and the pink is the residential. So a large majority, at least 50%, have commercial properties in their SMSF as opposed to the residential side. The total investment in property directly in residential investment was actually in 22-23 was 83.1 billion, representing 0.8 of the total Australian residential property market. Now that may not sound like much, but when you think so many people have their own family home and all the residential property market that we've got there, that is a significant number that's actually invested in property. Direct investment in non-residential property actually grew by 35% since 2018, 2009, so pre-COVID periods as well. But the SMSF investment in property is a significant area that we're seeing growing. And this comes from class. So there's two main superannuation software providers. So a bit like your Xero, you've got Class and BGL. They're the two superannuation. You need to use this specific super software because of all of the different SIS Act requirements that need to be dealt with. Now, they actually do these surveys because they have all the financial data there. So they've got it there. So why am I so excited about investing in property through super? There's a few things that you can really get some benefits out of: the income tax efficiencies, not only today, but also in the future in retirement as well. Today, we're at 15 cents in the dollar tax, which is a pretty good outcome. Retirement, once you're at what we call preservation age or pension age, so you might not go into retirement, and you'll hear this next week's session is about preparing for retirement, but you may not go into retirement at 60 straight away when you're actually able to. You might wait till 63, 64, whatever that age is. But when your fund is in pension phase, that actually means you will pay 0% tax on your income that you're earning in your super fund. Capital gains tax. Now, if you sell a property before you're actually at pension phase, you're going to pay effectively 10% capital gains tax. I mean, compared to what you pay outside of super, it's not much at all. Once you're at pension phase, you're going to pay 0% tax. So it's quite attractive from that perspective. Generally speaking, property is relatively stable and it is considered a growth risk investment. But if you're getting the right property, and I guess what a lot of us might be looking at buying, people generally see it as a lower risk investment, even though technically for markets purposes, it can be considered a growth asset and could be volatile. It depends on where you're probably buying. It does help you with diversification of your superannuation portfolio. And what's interesting as well is assets held in an SMSF are actually protected against your normal general debt recovery. So that can be quite attractive for a lot of business owners as well. And it may actually give you access to funds to make an investment in property. You may want to invest in property today and not have the funds outside of super to do that, yet you've got a few $100,000 in super and you think, well, hang on a minute, maybe I can get into the property market today. So some real benefits from property in your SMSF. I like to refer it to feeding your property addiction using your super fund because I do very much love property and I do see this as a big opportunity for a lot of people. Now, there's a number of different structure options. So I'm going to go through some of these with you because this is where, and again, this is general advice, but this is where it's not always a one size fits all for everyone. There's usually a way that we might be able to tweak things a bit to try and get the outcome that we're really, wanting. Is it something that your self-managed super fund buys the property outright in the self-managed super? Is it that you own a property outside of super and you want to put it into a self-managed super, assuming it's commercial? You may want to borrow to buy a property, or you may even want to do a property development. A lot of people think, how do you do that in super? There's a lot of hoops to jump through, but it's absolutely possible. I built my office doing this exact strategy. So I can speak from experience on that. There's a lot of hoops to jump through, but it's certainly possible. So let's look at some of the different structuring options when you actually say, I want to go and buy a property in my super fund. Now, it could be that you buy it outright. That were the old days. I say old days because we didn't have the options of being able to borrow. I do actually think that the lending, the ability to borrow in a self-managed super fund probably caused part of the growth in commercial properties, to be honest, because I know back in the old days, you could buy a factory locally for 200, 250,000. As soon as you started being able to borrow, all of a sudden these factories went up 300, 400, 500,000. Maybe that was part of the market, it spurred the market. But that's where if you've got a self-managed super fund, it can buy the property, own it in its own name. Residential properties can be purchased from third parties only, so you can't sell from yourself. Commercial properties, that's when you actually can buy a commercial property and put it in your super fund, and it can be bought from a related or unrelated party. In that case, the SMSF receives the rental income, incurs the property expenses, just like you would personally, and pays tax on any of that income. And the tax rate in your super fund is 15 cents in the dollar. Once you're at pension phase, again, big zero, no tax at all. Now, what's an in specie? So that's a legal word for it, but what is an in specie transfer? An in specie transfer is where you've taken non-cash, something that isn't cash. You've taken an asset. Now, I've done this many times for clients where sometimes they go to their accountant and they want to buy the property that they run their business out of, and their accountant isn't a licensed financial advisor, doesn't want to lose the client. So they actually say, oh, let's not touch super. It's all too hard to touch super. It's really because they A, legally can't do it, and B, don't understand it. So they go, oh, let's put it in a family trust. Big mistake, depending on your personal circumstances, but what a waste. So they'll often put it into the family trust. I'll get the client comes to me and say, oh, my prior accountant told me to put in the family trust. Where possible, I kind of do what I try to do then is what I call flip it into our self-managed super. It's called in specie, where we're actually saying, I'm not going to sell it to you for money, Mr. Super Fund. I'm actually going to put it in and use that as concessional and non-concessional contributions. So that's the in specie bit. Once we do that, SMSF receives the rental income and property expenses. Now, you might say, but hang on, if I do that, I've got this potential for I'm going to have to potentially pay stamp duty when I take it from, my own name and put it in. What I've been able to do, again, depends on your circumstances, and I work with lawyers to make sure we can do this, is I actually then kind of go, okay, they're the members of the family trust. They are beneficially the owners of the property through their trust. They are the members of their super fund. They are beneficially the owners through that point, and we will get the lawyers to make an application to the State Revenue Office for a stamp duty exemption. Generally speaking, that is something we're able to achieve. But I say potential. The difference between the ATO and the State Revenue Office, and anyone who's ever dealt with the state government, you're already probably rolling your eyes. The ATO has very prescriptive rules. You do ABC, we give you, this is the outcome. The State Revenue Office, in relation to their taxes, and I'm sure everyone's going, oh my God, land tax and all of the different taxes they've got. But in relation to even stamp duty, they don't give you prescriptive rules. You do ABC and we'll do this. No, they say you do ABC and you can apply to us and we'll let you know if we decide to give you that exemption. So they use their own judgment call, and there have been cases where they say no first, hoping you'll go away. And then we push back on them and then they give it to you, because I guess the State Revenue Office, especially in Victoria, is kind of a little broke at the moment. So that's where I say potential. It's not always a guarantee, but it's hopefully more likely than not. Then we have, what about if you've got unrelated business partners? Now, I do this quite a bit with clients where you might have two unrelated business partners operating a business together, and they want to buy a premises to run their business out of. We often look at them putting that property that they buy into a unit trust. Makes it a lot easier than your super fund buy half, my super fund buy half. How do we get the loan? How do we get the lenders to agree when the rent gets paid? How do we take 50-50? It's a bit complicated. So what we often look at doing is we get a unit trust, and the unit trust will buy the property. So it might buy the office, or it might buy the factory, or whatever that situation is. And the business will rent off the unit trust. And in this case, and this is the really good, interesting one, is that often we can actually use a mainstream lender to lend to the unit trust, because it's not super funds lending, it's the unit trust. If you've got two unrelated parties, we can lend to the unit trust. So what this means is, if I have an example where you might actually say they each buy $300,000 worth of what we call units into the unit trust. So from their super fund, they put cash of $300,000 from their super into the unit trust each. They get units. And now the super fund has $600,000 to use as a deposit to potentially buy, could be a factory worth $1 million, and they're borrowing $400,000. Now, we often will play with what that is. It that they're borrowing 400,000? Is it they're borrowing 600, 800? This is where your personal circumstances come into it, because I'm always a big fan of borrowing as much as you can so that you can invest the money in other assets and have two assets growing. So that's where it comes into your personal circumstances. But the unrelated business partners with the unit trust, this is a great outcome when you're buying a property together. Now, if you're doing a property development, I've made it look really simple on this structure here. You do need absolute advice on this, and there's lots of boxes to tick. But what we look at doing that is the super fund itself can't do the development in a sense itself in the super fund. And there's other restrictions around borrowings as well. So we need to have lender to the super fund who then puts cash and the unit. So the loan might be up at this level, at the superannuation level, and you might be using security from your house and other factors to be able to get this into the property investment. And because it's singly owned, you can't actually have a loan in this property investment unit trust. So there's a few ways that we can do things on this, but it really depends on your circumstances. But there is an opportunity to do a development in a sense, your self-managed super fund. It's just not in the super. When I built our office, that was the second, I guess, kind of development in an SMSF situation in a unit trust since the laws changed. I actually went to a super fund lawyer to get expert advice to make sure I don't screw up my super fund on it, because the laws around the SIS Act are so complex. I wanted to make sure I'd got it right. Now I've done it obviously myself. I guess that's probably something we often do at Smart, is we practice what we preach. Now that I've done it myself, and mind you, that was back in 2011. So since then, I've done many for clients now, because I've actually gone through that so many times. But you really, when you go to do this type of situation, you get advice up front and throughout it, because one false move isn't a case of, sorry, Mr. Superannuation Act, I made a mistake here. It does what we call taints the asset, and you have to get it out. So you can't even say, sorry, made a mistake, we're just going to fix it up, like we fix up something in our company or fix up something in our family trust. You have to get the asset out. So this is critical to get the advice and get that done up front. But these are all the different opportunities that I think not everyone is fully aware of what you can actually do with your superannuation fund. Now, when we talk about borrowing in a self-managed super, I always warn people when they go to start with an SMSF borrowing, and maybe I'm just trying to set the expectations. I always say to them, this is going to be the worst loan you ever go through. I've actually even got like 5 videos on our website to stage you through each of the processes and warn you how lengthy this whole process is going to be. And then what often happens, I get to the end and the clients say, oh, that wasn't as bad as I expected. But I think it was expectations I was trying to build you through, because an SMSF loan, it's now not through the mainstream lenders, and so it's a bit more challenging than what you're probably used to. So these loans are what we call limited recourse. They're a limited recourse borrowing arrangement. It means the bank has a limited recourse on the borrowing and just against that particular asset. So you could have lots of other assets in your super fund, but the lender only has access to that one asset. So let's just say you actually had an asset. We were discussing this situation yesterday, actually, where the asset was worth, I think it was worth 400,000 originally. They had a loan of, I think, 300,000, and the asset value actually had gone down through various different circumstances, unfortunate and all of the above, that the asset was now worth, I think it was like 275 or something like that. So the asset is now worth less than the loan itself. The bank can actually only get that asset. Didn't matter that the rest of the super fund had lots of other money and lots of other assets in it. The bank is limited to that asset. What does the bank do? How do they get their extra money? This is why the super fund loans can be a bit more complex. They have the members of the super fund are guarantors for that loan. So the bank do get their money. Don't think that they're going to miss out of their money. They're going to get it from the guarantors, just not your super fund. So I guess that'll be outside of super that they will get that. What it's important to note within SMSF borrowing, it's a single asset per loan. So you can't buy 2 assets. It can't be, I've seen it actually before where sometimes there's been the property and the car park has been a separate title. No, you can only have a loan for one asset. So it has to be just the one asset. There are higher costs in SMSFs, because when I say higher costs, that's compared to your normal residential home loan investment lending. And that's because an SMSF is a business entity. It's a trust with a trustee company, and it's treated as such. So it's treated along the business interest rates. You've also got to consider the cash flow, which is when we're going through financial advice and what the banks are all asking for. Have you been to a financial advisor? Have you got financial advice? And show us what's your exit plan and how's your super fund going to be able to afford it. And that's where you turn up there with your financial advice that's smart's prepared, happy days, you're all good. It is harder to then just kind of cancel unless you pay it out. But there will often be different fees as well. And in theory, you can't have alterations to the property. You can't do major renovations or major actually construction works to the property. Leasehold improvements, absolutely, the tenant would do that. Tenant might be your business, but you can't go in and add extra rooms or things like that onto the property as well. So there's just more restrictions that you have to satisfy when you've actually got that type of borrowing arrangement. So how might you have this type of structure? Now we call it, so at LRBA, so limited recourse borrowing arrangement, but basically it's a super fund loan. You may actually have either I'll do two scenarios, one where you've got a third party lender and the other one is where you lend your super fund the money. So if it's a third party lender, what's the biggest difference from normal lending? So the third party lender will actually have the loan with your super fund, but they've actually got limited recourse over, and when you buy a property and you're going to have a loan on it, so if you buy it outright, this is not applicable. But if you have a property with a loan on it, you are going to have to set up another trust. It's a bare trust and a trustee company. That's not going to lodge a tax return. It's not going to do financial statements. It's going to do nothing except for holding the title to the property. So it will hold the title. Once your loan is paid out, that title can then be transferred with the Land Titles Office to your super fund, no stamp duty, all good on that side. But it's because it's part of a limited recourse borrowing arrangement, this is the structure that needs to happen. So you have a bare trust that holds the title. Your rental income's going to go to the super fund. Everything else, the loan repayments will go with the super fund. All of that's normal, but the title will be held with the bare trust. Now, if you have a related party loan, so there's actually nothing that stops you from doing a related party loan. If you have equity or cash outside of super that you didn't want to get into your super, maybe depending on your personal circumstances, there may be reasons for that, but you can actually even get a loan. Maybe you get some equity out of your house. So you borrow against your house, you get that loan. You can then actually have a related party loan to your super fund. However, we do have specific requirements. There is a tax office, what we call PCG, which says this is the interest rate to use. This is the term of the loan to value ratio, the security, the mortgage must be registered. So we always get the conveyancers to do that, a repayment schedule and loan agreements. This has been really good where I've had situations where it may have been challenging to get the loan for a particular client. Maybe the property they're buying is in a regional area, which makes it harder to get lending, but we're able to get it through their house and then lend it on. So that's where this can be a solution if we can't get a loan directly. If you can get a loan directly, because to be honest, the interest rate that you've got to do here anyway, under the ATO is actually at the moment, it's higher than the interest rate you're getting from the lenders. And in your own name, you would be able to claim a deduction for the interest you're paying on the money you've borrowed to lend to the super fund, but your interest rate is probably going to be a lot lower. The super fund will pay you interest on the loan that they borrowed from you, and you will be taxable personally on the difference. Your income is probably higher than the interest expense, especially at the moment with the loans under this PCG being higher than what's actually in the market at the moment. Again, you do have the bare trust, but this gives you options to actually work out how can we structure this situation. I've often even done the related party lender when I've had the in specie situation where they've owned the property outside in a family trust or something like that, and we've done concessional contributions and non-concessional to get the property into super from an in specie, and then we may have done a related party loan for the balance. But again, we just need to look at the circumstances and see how we can structure that for you. So generally speaking, the big four banks are no longer lending. There are lots of other second tier lenders. And just because they're second tier, it doesn't mean it's low doc. We're talking superannuation. So often it will be, well, basically it's full doc, as full doc as you can be, but you're going to have a business interest rate. Now, why did the big four banks get out of this type of lending? It wasn't anything to do with SMSF loans itself. Actually, SMSF loans are great for the big banks and the funders because generally people don't change their loans very often. You don't refinance every other year or two with an SMSF. If you've got a good rate, set and forget and just let it tick on. It was actually to do with nothing to do with SMSF loans. It was actually to do with the bank's lending ratio of residential, consumer versus business and all of these different stats that just meant a lot of the big four went out of that space so that they had more on their balance sheet to lend to lots of little consumers like us. And so that was actually unrelated, literally. NABs still do SMSF loans, but you need a minimum member balance of over 5 million. So there's not that many people that qualify for that one. The interest rates are at a business interest rate. So if it sounds like it's a bit higher, yes, it's a business interest rate. Now, offset accounts are now available with SMSF loans. And up until about 2 weeks ago, I thought these were fantastic because if you want to, you can always put a bit of money in there in the interim. Looks like the ATO, they've just come out and said they are reviewing whether these are valid for under the SIS Act purposes. So I'm going to hold myself on that one and not be doing any offset accounts at the moment because the ATO is saying that they don't think that that is allowable under the SIS Act. It's only been going for a few years now. It took them a while. Anyway, so we'll see what they come out with. It is important to have a clear understanding of the structure. As I've just gone through some of the structuring already, if you're going through financial advice and we're going through the looking at these types of structures, I really will sit you down and make sure that you understand where things are. Understand that the conveyancer, the lender, here's the bare trust, these are the names, this is the super fund, here's where your rent goes, just so that you've got it right up front. Once you've got it structured up front, we're all good because it'll be each month, you'll have your rent going in the same place. But it is important to get that right up front. Now, when the banks are looking at your lending, generally speaking, the banks are not going to look at fully your personal situation because they're looking at the SMSF. Are there regular super contributions coming in? If there aren't, they'll ask why. And that's when they'll look at your personal situation. Is there rental income coming in? Can the SMSF service the loan on the rental income they're getting and the regular super contributions that have been going into your super, whether that be a self-managed super or maybe your prior retail super fund? And if we can show that you've had regular super contributions going in for the last few years, happy days. If you do some lump sums, they'll want explanations around that. Now, when we talk about loan to value ratio in a super fund, look, maximum debt is generally 70%. Now, the reason I say that, there are some that we can get at 80%, some residential you can get at 80%. Most popular tends to be at 60 to 65%, depending on the interest rate, depending on the superannuation balances. But the loan to value ratio, this is a really important one to think about. And the reason for that is, and I've got examples later, that if you have a certain amount in your super, I'm encouraging people to borrow as much as we can so that you can invest that money in another asset, because 2 years ago, it wasn't the case, but we're slowly seeing that turning around now. We're going to start to see interest rates coming down, and the investment returns are still, despite all the stuff that's going on in the US and everywhere else, it is a bit of a funny market, but there's still really good growth coming. So we are finding that we can kind of at the moment easily outperform the interest rate from an investment returns perspective. As I always say, past performance, not a guarantee of future performance and all of those things, but that's what we're seeing at the moment. So having that loan and having two assets growing, given that when you're doing this for retirement. When it's in your self-managed super, you can't grab it out. It's for your retirement. So if you've got time on your side, that's where it's worth doing. The banks are always going to want to see that you have a buffer of funds, that you're not, we usually say, is it 20,000? But they like to see that you've got a buffer. Again, it comes back to that financial modeling that we've put together. Commercial property, if it's a related party tenant, it's going to be all of the above, plus they're going to look at the business performance. So if you're going to be renting to your own business, they will want to know that your business can afford the rent because that's going to be the rental income that they're relying on. When we do financial advice, we also do SMSF financial modeling, and we include a 2% interest rate stress test as well. So we actually say if the interest rates went up by 2%, could you still afford the loan? The banks are going to do that anyway. They actually do. They're using a buffer rate when they're doing serviceability of 3% anyway. But the 2% is, can you afford it? The ironic thing is, a few years ago we did that with some clients, and as we've all seen, those interest rates went up by 2%, and they could still afford it, which is the good thing. And just warning you that with the loans, there's lots of paperwork. So, just bear with us. We've got a nice little step by step to try and help you through that process. Once it's in place, happy days, but it is it's a journey, let's just say. So SMSF properties, what kind of property can you actually invest in if you're wanting to look at investing in a self-managed super fund? What kind of properties? Now, one thing I want to say about properties is negative gearing, and you can negative gear in a self-managed super fund, which is fantastic. I love that part because the negative gearing loss, because of depreciation and things like that, offsets the tax that I would have paid on my super contributions. So negative gearing is great, but negative gearing without capital growth is just social housing. And if you think about that, if you're getting a loss benefit, but you're not getting the capital growth, you're just funding, so it's social housing. So really making sure what it comes down to when you're looking at property, buying in an SMSF, same as when you buy property outside of super, do your homework, do your research. You need the property to go up in value. That's your long game. You are investing in property for the long game. If we can get some negative gearing benefits along the way, absolutely fantastic. But we want this asset to go up. So what kind of properties can we look at? You can actually buy vacant land in an SMSF, but again, as I said earlier, you can't then develop on it. So I'm not sure why you would do that. And there are restrictions on vacant land on lenders lending to a super fund to buy a vacant land. Why? A lot of the lenders are nervous that you're going to develop on the land. As soon as the ATO or the super fund auditors find out, the asset's tainted. So the only time I've really kind of seen on the vacant land is where it's maybe farming land. So a lot of farmers would be, and you're probably hearing a lot from the farmers with their land and the 3 million super issue at the moment. A lot of the farmers are going to get dinged on that one because they may have huge land holdings. Residential, you can do a residential house, apartment, units, any of those. Commercial, so you see a lot of commercials. You saw earlier, a lot of people invest in commercial as well. Factories, medical suites, offices, like the smart office in the super fund as well. And where you can actually get new, established, or off the plan. So you can do all of those. All of those are options in super. So you've got a really good ability to kind of tailor it to what you prefer. Now, I put together a few scenarios, and these are recent, these are true story ones. And as I always say, past performance, not always reflective of future, but I'll give you an example of why some have done off the plan and then also the business premises. They're probably the two that we do tend to see. One scenario I had purchased off the plan September 2021, cost them 890,000. Settlement was January 2025. The actual value of settlement, the bank valuation was 1.25 million. So that one had a capital growth of 360. We've had others that have been, 50,000, 100,000. But the bit I like to point out, and this is why I see a lot of people want to invest in property, and there's no guarantee, as we say, there's no guarantee that property will always go up in value. We see it go up. No one has a guarantee on any of that. But the bit I like to say, especially in super, when you have time on your side, when you're doing this in your self-managed super, if you're not retiring next year or the year after or in 2 or 3 years, you have time for your asset to grow. So this 360, and the way I calculated it with this particular client, they nearly fell off their chair when I actually put it in these terms. Great. The 360,000 was an amazing capital growth. They did really well on that one, and there was a few different clients that had done similar on that. They paid an $89,000 deposit. They couldn't have afforded at that time to, they were investing in shares. They couldn't have afforded to settle and buy a property at that day, but they spent then the next 2 years. They did the deposit. They spent 2 years putting more into super to enable them to be able to buy this. But basically their deposit of 89,000 generated 360 growth as well. But the other way I like to look at it with property is to match 360,000 via employer super contribution, so 12%. That is 3 million in wages to actually match that, which is kind of crazy. If you go 3 million times 12%, that's 360. Now, even if you took a zero off that, let's say the property you bought and you had a $36,000 uplift, right? That's still 36,000. That's still 300,000 of wages at 12% that you didn't have to, well, you didn't have to kind of earn, and you got that uplift straight away. So that's where some of it. But the other thing is, again, it comes down to the property. Not all of the plans do well. You need to do your research. You need to make sure you buy the right one, because I have seen some that have gone the other direction as well. But just to give you an analogy of why do people like property? What do they see with that capital growth? And what is the impact when we're looking at it from a superannuation perspective? In my mind, when I put it back to say, well, my alternative instead of that may have been putting extra into super and obviously investing in shares and things like that. But here we only invested 89,000. So again, it goes back to, and I love property, but I am not the property expert. I can't tell you that one's going to go up by, 100% and that one's going to go up, but, happy to talk about property with you because I do enjoy it. Another one, also recently, to give you an example, was purchase a commercial office for $1,050,000. This one was about a year ago. We used 30% deposit from the SMSF. They got a 70% loan. Now, why did we get a 70% loan? Is they actually had more funds in their super, but I was actually like, let's get a 70% loan, because if you've got, if we pay down that one property more, so you end up with 50% loan, that extra 20%, you've actually got invested in one asset that's growing. If I take that extra 20% and we put that into the share market, or potentially these people love property, so we've got it in the share market at the moment, give it another year or two, and they'll buy, and they'll use that money then as another deposit, because they want to get up to the 30% again, to buy another property. And going back to what I said earlier about taxes, once you're at pension phase, so you can go into pension phase at 60, that may or may not be appropriate for you, but once you're at that, you actually could, you might have 3 properties. I've got a few clients that got 3, 4 properties where we've got them maxed out on the debt for each of them. As soon as they save up for the next deposit, they buy the next one. And their goal is, when I get to 60, I go into pension phase, and they're hoping they'll sell one of the properties, and hopefully the sale of that one, which will be 100% tax-free, no tax, will pay down the debt for the others. So that's kind of the strategy, in the fact that we have zero tax. Whereas if you owned that property outside of super and you're 60, you pay normal capital gains tax on that one. You still get a capital gains tax discount and all of those things depending on the structuring, but you actually pay tax personally. Whereas if it's in super, it's tax-free. Once you're at 60, you can then take that cash out. You sell it and you take the cash out of your super, because you can. So in this particular situation, this one was a great outcome for the client. They had the 30% deposit in the super fund. The premises was going to be too big for them. So renting the premises 100% with their business would have caused probably a bit of strain on their business, because it was definitely a lot bigger than what they needed. So what they actually did is they had the 30%, they borrowed 70%, they rented, half the premises is rented to themselves, their business. The other half, they've actually rented it to unrelated parties. They're both paying market rent, their business and the other parties, but they've ended up with a really good outcome. Interesting too, for this particular situation, they've ended up with more rent than had their business rent it all, because when you have 2 smaller properties, 2 smaller per square meters, the cost per square meter tends to go up. So we always have to rely on agents to give us the market rent, because we need that for super funds on the arm's length. So business pays the rent to their own SMSF. The SMSF is building equity. They're paying off their own asset, not someone else's. The fit out costs, and this is the beauty of it. When you're doing this, you've got to be at arm's length. So your super fund has bought the property, could have rented it to anyone, related, unrelated. And so the fit out costs, which are often the most expensive, is actually paid by the business at a higher, and they get a deduction at a higher tax bracket. So they've only owned this 12 months. For them, this one was actually in Mornington. They've owned it 12 months. We just had their valuation because they'd done, and this is the interesting thing, they'd done the fit out. Fit out looks great. The third party that's rented 50% has done their fit out as well. Looks amazing. And we had to get it valued for the super fund auditors, which we have to do every year. And it was 200 grand increase in the value. So really smart use of their super, and also something they didn't know was going to be possible, because yes, their super had the balance that they could have done it, but they didn't think they needed that space for their business. And I said to them, well, you could actually, split this one in the middle and rent it out as, two different sites. So that was a really great outcome on that. So whenever you've got ideas on what you might be able to potentially do or what you'd like to do, it's trying to bounce those around and work out how can we make it happen to actually get that outcome whilst making sure we comply with the SIS Act requirements. So I just want to touch a bit more on the negative gearing. Negative gearing in a self-managed super fund can be really, really beneficial depending on your age and where you're at in getting close to retirement or not close to retirement, because you've got your tax deductions in a sense, you get for the property losses. So just like negative gearing outside of super, where you declare your rental income, you claim your rental expenses, you have obviously you've got your interest, but you've also got depreciation as well. Now, if it's commercial property, we don't have restrictions on depreciation. We get to claim all of that as well. When you get that tax deduction in your super fund, you actually can offset that negative gearing loss against other income of the super fund. Now, that other income in the super fund is probably your contributions, whether it be employer contributions or personal contributions that would normally be taxed at 15 cents in the dollar. Now, you can absorb those losses, the negative gearing losses, and you can reduce your tax. So you might even find, and this happens for a few clients, and this is where the financial modeling can be really beneficial. I'll find maybe it might be 5 years, 6, 7 years, that through the earlier years of negative gearing, and it just tapers off as time goes on, but the earlier years of negative gearing, we're actually able to achieve maybe no tax payable by the super fund, even though you're in accumulation, which means, yes, 15 cents in the dollar tax, but any negative gearing loss we can carry forward. So there's been a number of client scenarios where I've been able to have, maybe 5, 7 years of super contributions being absorbed by these negative gearing, so non-cash deductions, especially with depreciation, and saving on tax. I've even had some that we were able to have it and had no tax for like a good 7 or 8 years. Then 2 years later, they went into pension phase and there was no tax. So it was a fantastic outcome. So when you're going and buying property, generally, you don't always get this big uplift straight away. Sometimes you do, and then that's going to plateau. So even that client that had a really big uplift at that point in time, I don't expect that's going to keep going up every year. What are they? I think the stats are is that 6.8% is the rate that I think CoreLogic comes out with, the average on property going up. So you may not get that every year, but property is a long game. Generally speaking, you don't buy the property down the road and expect it to double in value overnight. It's a long game. It's a 10-year type of time frame. And if you've got that time on your side from a retirement perspective, then you can let it build up wealth in your super. If you don't have as much time until you're going to be requiring that, that's when you might want to think and make sure you've got some diversification where you have, values in shares or something like that, because otherwise you can't sell the roller door to pay some of your pension. But, if you've got the capital, if you do sell the asset, 10% CGT, if it's if you're in accumulation phase, so you haven't yet retired, and then it's 0% as well. So really some great opportunities in super. And I guess in the super, it also means because you're able to access some of these funds to get into the property market. I look at the property market now and think it's pretty good opportunities at the moment. Things are kind of flat. Things are not moving as quick as they normally would. So I think, I do believe there's no such thing as a bargain in property because, there's two sides of it. But I think there are opportunities at the moment. I guess speak to some of the real estate agents. I'm sure they'd be saying the same thing as well. Now, just to touch on related parties, because people do get very excited about the ability to buy their business premises in a self-managed super fund, or, hey, can I buy an apartment in Melbourne and then in years to come, my kids can rent it out while they go to uni or something. So just to be really, really clear, when you're dealing with related parties, and this is a really big thing because, again, if you taint the asset, you can't just fix it. You can't fix up with documents and, beg for forgiveness. No, asset is tainted and must get out of the super fund. So that's the risk. That's why you need to get it right. So when you're dealing with related parties and property, it can only be a business property. It cannot be residential when you're dealing with related parties. So you can't buy from a related party that's a residential property that you own personally. You can't rent it out to someone that you know. The definition of related parties within the SIS Act is that wide, very wide, nearly captures lots of people. So really got to be careful, because if it gets tainted, you've literally got a limited time frame to get the asset out, and you can't even sell it to yourself because it's related party. So you must pay market rent to your self-managed super fund. So the commercial property must be rented at market rent, and we have to get a validation of that from an agent. You must have a proper lease. The benefit is you are getting a tax deduction. What I do like about it is you're getting a tax deduction at probably a higher tax bracket in your business, and you're paying lower tax in your super fund. Again, as I said, residential property, including holiday house, all of the above, cannot be in your super and then used personally. And any purchase or sale must be at arm's length. It must be, and the State Revenue Office, when they change the title over, will be checking all of that, and then the super fund auditors as well. So when it comes to property, it is very much a one size doesn't always fit all. That's why we need to have a look. And sometimes it'll be, people will come to me with questions. I'll be like, let me just have a look. I need to check on that, because there are different specifics as well. SMSF lending, it hasn't always been available, but it is very different from regular lending, and we can structure it in certain ways, but there isn't kind of that, one size fits all, but there is a way where we can try and pull it off to achieve that, that side as well. So when you look at, and this is what's interesting with the self-managed super fund, as we talked about last week, if you attended last week's, we talked about what's your investment strategy. Now, when you've got your super in a retail fund, one of the big superannuation funds, you're going to hope that they've got an investment strategy. What is their strategy to invest your funds? So the self-managed super fund is exactly the same as we discussed last week. You need an investment strategy. So you need to think about, and this is where we will often financially model with clients, you need to think about, do I want to buy, and I'm just going to use this example. You want to buy a factory at 600,000, let's just say, and have no debt, because you've got 600,000 in year one, you've got 600,000 in your super. I want to buy it outright, no debt, and happy days. I don't have to worry about debt. And then you're going to have annual super contribution. Let's just say two of you over the next years, 2 to 5, 60,000 cash, and that'll just be invested in shares. So you've got no debt, but you've only got one asset growing, and then a little bit of, cash being then invested in shares each year, but that's all you've got growing. Another scenario, and this comes down to, again, personal circumstances and your comfort level with having potentially debt. And I always say, if it's in a super fund and you've got time, then just let it do its thing. The alternative is, and you might not do this outside of super because you may not like having lots of debt, but in super can be very different. And this is where when we financially model out the two outcomes, and we can say in 10 years time, here's where you'll be. And in 20 years time, that might make it a bit of a no-brainer at that point. When I look at some other clients, they might look at buying a factory. So in year one, they buy that $600,000 factory, but they actually get a loan for it. And so they've got $390,000 of debt. So they've got 210,000 that if they bought it outright, they wouldn't have available. Instead, they're going to take that 210 and we're going to invest that 210 in the stock market. They'll probably make extra super contributions, and they may actually buy in year two, they may actually purchase an off the plan apartment, say, because Why? Because they pay, maybe if we think back to that earlier one, $80,000, $90,000, so 10% now, and it's not finished for another 2 years, right? So they're actually, even though I've got here, maybe it's worth 600, and ultimately it will have the 390 debt, but it's not going to be finished probably for a year or two. So they've got a year or two to save up the extra money for the deposit to then get them in a position, and we've got more cash being invested. And then potentially by year 5, and these numbers are actually, I'm using someone's scenario, but what we've got here in this scenario, by the end of year 5, we've got the debt there, we've got the assets, but we've actually got 3 assets growing throughout that period. And if you're not retiring until, say, year 10, you've got 3 assets growing. And yes, you have the debt, and the debt's being paid off with rent and your super contributions, but you actually have 3 assets and a nice diversified portfolio. Or actually 4 assets. You've got your first factory, you've maybe got the residential, and you've actually potentially, in this particular client, they love property, so they bought another factory. You may actually just keep the money in shares, but you've then actually got, so 3 properties and shares, all like, so 4 assets growing versus the other scenario of just 1 asset growing plus some money in shares. So I think it's looking at why you want to look at the big picture, not just today. It's what is your ultimate goal? When are you thinking of retiring? When is retirement? Is it 5 years, 10 years? Let's model that out so that you can make an informed decision of what your investment strategy would be, because that's going to make a huge difference to your retirement from that perspective as well. So as I said, thinking about what type of property, the structure within the SMSF, what's the most appropriate. You might have a 100% in your self-managed super and you're 50-50 in a unit trust because you're doing something with a business partner. What's your future cash flows, where you can model it out, making sure you understand it, and thinking property long term. Get the advice to make sure you get it right, and have that financial modeling so you can make a decision today based on what the expectations are on going forward in the future. So how can we help? Well, obviously tax and all of those related services, but on our financial advice, I find with the SMSF advice, being able to financially model it out and show how that impacts your personal situation as well can have a really big impact. So I can actually financial model and say, this is what you're going to retire on. Is that looking like what you want it to be or not be? But also thinking strategically around your lending and how you want to deal with that as well, because they're all kind of interlinked as well when it comes to self-managed super funds. So I just think I'll open it up. I've probably covered a lot on properties there. Just I thought I'll open it up to see if we've got any questions there at the moment.
Yep. So Shannon, if an SMSF purchases a property, can that property be used in retirement at all?
So if I'm assuming then they're talking about residential. So what that would mean, if it's commercial, you've probably been using it anyway. There is a really great thing that you can do with residential property. And that's a really good question. I should have mentioned that. Note to self to put into the presentation next time, because I have actually done this with a few clients. You can actually buy a residential property in your self-managed super fund that you might say, I want to buy that property in the Gold Coast. I can't afford to use it now and buy it outside of super, but I'd love to have it in my retirement in 10 years time, 15 years time. You can buy it in your super fund. You cannot use it at all now. Between now and until it's yours, you cannot use it because it's residential property. You cannot stay in it. You cannot do anything. So don't. But rent it out to other people. Let them help pay it off. And then when you get to retirement, you can turn around to your super fund and say, I want, not only do I want a pension, Mr. Self-Managed Super Fund, I also want a lump sum. But you know what? You don't have to pay me a lump sum. You don't have to pay me a lump sum in cash. Do you know what? I'll just take that property. And then you can have that, and you have to go obviously to the State Revenue Office and get that all passed out. But assuming it's going to the same members, all of that, it'll be the same beneficial owners. So there should be, again, we have to ask for permission, ask for the stamp duty concession on that side, and you've taken the lump sum. Actually, I had one client that's done that, they did it about 10 years ago. bought the worst house in this particular location, and their goal is that once they get to retirement, they're going to bring the property out as a lump sum, knock it down to rebuild prime location. So that's a really good question, but you cannot stay or do anything with it between now and when you actually get to take it out as a lump sum pension.
Great. And Shannon, can you use equity from one property purchase for another property purchase?
No, unfortunately, that is a big no. And so that is why buying one property and 100% paying it out, you've now got to put extra money in to be able to build up to get the next deposit. That's why I kind of say, look, borrow the maximum so you've got that extra cash. We can invest it in shares. Now, in the past, sometimes clients have put that in the offset account. I mean, shares, we can often outperform what that rate might be, no guarantee. So if they're looking at doing something quite quickly, we were putting it into the offset account to build up those funds in the interim, ready to buy the next property. As of 2 weeks ago, the ATO might be putting a stop to that. We'll see what they come back. The ATO just pop their head up sometimes and they go, hey, just so you know, we're looking at this. We don't think we like it anymore, which is kind of means that we all start to freak out and work out what they're going to do. So you may not put in the offset or not, but you can't. Whereas outside of super, you can use cross equity from others to buy the next one, draw the equity out. You can't do that in super. Going back to that, it's an initial loan. It's a loan per asset basis. And even if you paid off that loan, so if you paid off the loan, you can't then refinance it for another loan. Once the loan's paid off, that's it. You can't get another loan on that property. You can refinance for the same amount, but you can never go higher.
Great, thank you.
Any other questions at all? No? No? Well, if you have any other questions, reach out. So our upcoming webinar, our last one in this three-part of SMSFs, we were getting a lot of keen interest on SMSFs and hence the three parts. But we're going to talk about planning for your retirement now that you've got your SMSF, if you've decided to do that, and also planning for your retirement, even if it isn't a self-managed super fund, just planning for your retirement in general as well. So that is next Friday as well. All of them will be recorded. So register if you're not going to be able to make it and you'll get that recording sent out. They'll all end up on our YouTube. So if you go in and like the YouTube, you'll get a notification every time we put something else up as well. We also do have a podcast, The Accountant That Builds. So it's not only building, obviously, property, which I do very much like. It's also building wealth. And a lot of these types of strategies, I talk with a lot of guest presenters as well on those. So thanks very much, everyone, for joining us. Looks like we're going to finish right on time. Thanks very much for joining. If you have any questions, do reach out to us. Thank you.